Over the years, so many people have come to me and they said, why should I invest? What's the reason behind doing this? All I want to do, put the money in the bank, put my retirement savings in the bank, and then I'll get peace of mind and I can sleep at night. So after 30 years of working on trading room floors and advising institutional investors and investing my own money as well, I can tell you this is not the right strategy for everyone. Yes, it may be a good idea for some, but it isn't right for everyone. What I want to do now is share with you 5 good reasons why this might not be the right strategy for you. So here's the 5 reasons. The first one is inflation. The second one is what happens if a bank goes bust. The third is what we call diversification. The fourth is you need to account for your strategy to work for you personally, not for some generic individual. And we'll talk about that much more in detail in a moment. And then lastly, opportunity cost. What economists call opportunity cost is the money you could have made elsewhere. So yes, you'll have great access to all of your money if it's in the bank, but do you need such access? We're here to help you. We'll give you the tools to enable you to better manage your investment portfolio, to give you more peace of mind and more financial security. If you don't want to waste your time, you don't want to waste your money, and you're certainly not a gambler, so you want to make good investment decisions, have a look at the link below to our website, or you can reach out to us by clicking the contact button. You can also subscribe below to watch more videos. So let's start by looking at one of the biggest single risks which affects anyone who decides just to leave their money in the bank. Inflation. Even if inflation is very low, as it has been over much of the current century, let's say 2% or so, that seriously will erode your purchasing power over time. So if you have $100, you leave that in the bank, it's going to lose 2% a year just because of inflation. And that means after 10 years, it'll have lost somewhere between 15 and 20% of its purchasing value. That is not a great outcome. And it means, therefore, that if you want to protect your savings against inflation, you either need to find some kind of savings products which is inflation linked, and there aren't very many of those, or alternatively, you look for products which will give you a return which will beat inflation. Now you might say, does this matter to me? Well, if you're in your mid-40s, mid-50s or mid-60s and you're saving away, chances are you could be using those funds 10, 20, 30 years hence. And even at that very low rate of inflation of 2%, your purchasing power is going to be seriously eroded. So one of the main reasons people choose to invest is to, at the very least, offset inflation. Now, you may feel comfortable perhaps leaving all your money in the bank, but bear in mind, banks can default. We've seen this in the global financial crisis, and we've seen it since. Now, in most countries, there is a limit to the amount of insurance the government will provide if your bank goes bust. And that means providing you have less funds in there than that limit, you're always going to have your capital protected. But if your funds are above that limit, then you're really taking on a very large risk that the bank where you've deposited your money is going to go bust. Now, of course, the vast majority of banks are still going to be in business, I hope, many years from now. But how do you know which ones will and which ones won't? And secondly, you're taking a risk without being paid for it. You're taking the risk the bank goes bust, rather like a bank shareholder actually, but there's no one paying you shareholder dividends in return. So I think if you've got more money invested in a bank than the protection limit which is supplied by the government, so in other words, your deposit is uninsured, then you want to think very carefully about leaving money in the bank. Diversification is one of the things that many professional investors will always tell you that you need to have. Now, if you put everything in the bank, that's the one thing clearly you have not got. You have not got diversification. Now, why do you need it? None of us really have a huge degree of certainty whether over the next 5, 10, 20 years, the stock markets or the government bond markets or even bank accounts are going to be the greatest performers. It's very hard to tell. So one of the safest things to do is to make sure that your assets are split between asset classes so that even in an uncertain world, when an asset class performs, at least you're going to get a bit of that performance yourself. So diversity comes free as well. It doesn't cost you anything to have a diversified range of assets. So I think it's always worth considering whether you just want to go for one asset class, being bank deposits, or go for a collection of them. You also want to consider what economists call the opportunity cost. That if you're putting your money in the bank, you are not getting the returns which might be available in other asset classes such as equity. Now, over the long term, which asset classes have been the best performers? And I think you'll find that equity has been one of the best if you look back 10, 20, 30 years. Now, your retirement may be many years hence. And of course, we can't forecast which are going to be the best performers right now over that time period. But if history is going to be repeated in the future, then there's a good chance that equity will be one of the better performers. And certainly that bank deposits may well be one of the worst. Now, of course, that doesn't mean that at every moment in history you should always be fully invested in equity, property, or some risky asset. Not at all. There are times to invest in each of them, and getting that timing right, of course, matters. But over the long term, you really need to think, by putting all my money in the bank, is there not a huge opportunity cost for doing so? In other words, am I missing out? And of course, you need to consider whether your asset allocation, in other words, the asset classes you've decided to invest in, are appropriate for your age and circumstances. In other words, if you believe that you have a very short time left to live, then of course having your money in bank deposits where you can access it quickly may make a lot of sense. If on the other hand, you're still working, you're still investing, and you're not intending to use that money for many years into the future, 10, 20, 30 years ahead, you may choose instead to go for asset classes which are less liquid, but which will give you better returns. Now, of course, many of us are in the middle somewhere. Some people have just retired and they still won't be using the funds in their portfolio for another 10 years, say, or 20 years, say. So everyone is sitting on the spectrum between those two. And it's a question of deciding what is the right asset allocation given your age profile, your risk appetite, and your forecast for what the funds are that you're going to need over the coming years. Now, that's personal to you, But it certainly suggests to me there aren't many people for whom the right asset allocation is to place everything in the bank. In other words, for many of us, we really ought to be looking at how we can invest funds across many asset classes. Don't want to leave your money sitting in the bank? Want to know more about how to invest? We're here to help you and give you the tools to better manage your investments. Most importantly, to give you the peace of mind and the financial security. We don't give investment recommendations or investment advice. But if you don't want to waste your time or waste your money, have a look at the links below and click subscribe to see more videos on these topics. Thank you for watching.